Right now, one conflict is doing far more than reshaping borders. It is shaking currencies, energy markets, and the global economy. In this backdrop, India keeps coming into focus because it is one of the countries most reliant on energy imports and international trade. That makes developments in the Middle East feel immediate, especially for households, businesses, and policymakers in India, and the next move could hit families. On the surface, India's economy looks vast and resilient, but like every major economy, it carries structural weaknesses. The biggest of those weaknesses is energy dependence. In plain terms, India must bring in large volumes of oil and gas from overseas to satisfy demand. Whenever tensions rise in the Middle East, oil prices are usually among the first variables to move, and India feels that shock quickly at the consumer level too. Today, global uncertainty has climbed sharply. Investors are uneasy, pressure is building in the Forex market, and the Indian rupee remains under strain. When a currency weakens, both the government and the central bank face greater pressure to steady the market and reassure investors overall. That is why the Reserve Bank of India is adding billions of dollars to the market to ease the dollar shortage and calm nerves. But no economy can be stabilized forever by simply pouring in dollars. If the deeper issues stay unresolved, the pressure eventually returns once more. The core issue is that India is caught in a double squeeze. On one side, oil prices are climbing. On the other, shifting American policies and changing global alignments are making cheaper options harder to access than they were roughly a year ago. Previously, India bought oil from Iran. Later, it also imported discounted oil from Russia, which helped because energy arrived at lower prices. But if the Iran conflict deepens and pressure on Russia rises further, securing inexpensive oil could become much more difficult for India quite soon. Remember, oil is not only about vehicles. Higher oil prices mean transport gets costlier, power gets costlier, industry gets costlier, food gets costlier, construction gets costlier, daily life gets costlier. In short, one factor can ripple through the entire economy very quickly indeed. Inflation is already a serious concern for people in India. If the rupee weakens further, imported goods can become even pricier, especially gold, mobile phones, electronics, industrial machinery, medicines, petrol, and diesel. All of these could end up costing more across the board. At that stage, the concern is no longer only economic. Political pressure also grows. When inflation rises, public frustration rises too. It becomes difficult for governments to keep people satisfied under such conditions for long stretches ahead. At the same time, pressure is also growing on Indian banks. If fear spreads in the market, people start buying dollars, capital can move abroad, and banks face trouble managing liquidity. That is why the RBI is trying to support the banking system through swap tools and dollar support. The aim is to tell the market that the central bank still has the situation firmly under control at present. But the real question remains, how long can this continue? Because if the conflict drags on, threats around the Strait of Hormuz continue, and global trade keeps getting disrupted, then not only India, but supply chains around the world could be affected too. Europe has already faced an energy crisis. Countries like Japan and South Korea also depend heavily on imported energy. China may be in a relatively stronger position because of its huge manufacturing base, but a slowdown in global markets could still affect it overall. Now consider another important factor. One of India's major strengths is remittances. Indians living abroad send billions of dollars back home every year, which supports the economy. However, if Gulf countries experience economic slowdown, or if the effects of conflict spread there, remittances could also be affected. Likewise, Indian airlines, shipping, and import-export businesses will also face pressure. If fuel prices keep rising, air travel becomes more expensive, freight costs go up, and business expenses rise across the board too. On the other hand, global politics is changing very quickly. The United States wants to keep pressure on Iran through its policies, while Iran is clearly signaling that it is not ready to step back yet. The Strait of Hormuz is not just a sea route, it is a lifeline for the global economy. If tensions stay constant there, swings in oil prices could become the new normal. That is why global markets are closely watching every statement, every attack, every sanction, and every diplomatic meeting. For India, the biggest risk is that if investor confidence weakens, then not only the currency but also the stock market, banking sector, and industrial growth could suffer. And if recession-like conditions emerge globally, export demand could also decline, adding extra pressure on India's growth. At the moment, the world stands at a point where a regional conflict could become a global economic crisis. That is why every country is trying to strengthen its own position now. In the days ahead, all eyes will stay on Iran, the United States, Israel, Russia, and the Gulf region, because the decisions made there will shape not only political outcomes, but also the future of the global economy.